Testing. Okay. The stock market keeps going up, but something in the credit markets is quietly flashing red. In this video, we break down a chart that most investors completely ignore: the tech sector 5-year credit default swaps. We'll explain what it is, how to read it, what it's telling us right now, and why index fund investors may be far more exposed than they realize. So if you're watching this right now, I want you to stop whatever you're doing and really pay attention. Because today, we are talking about something that most financial channels are completely ignoring. And honestly, that's exactly what makes it so important. And the reason they're ignoring it is because not many people are familiar with the credit default swap. So we're looking at the chart today, just one chart. But this chart, when you learn how to read it, tells you a story that could change the way you think about your portfolio entirely. The title says it all: Tech Sector Credit Risk Pricing. Now, let's be honest, that sounds like a boring headline, but trust me, by the time you're done today, we are going to understand exactly why this matters to every single person who owns an index fund, a 401k, or any kind of investment that has anything to do with tech stocks. So let's get into it. First, let's set the scene. This chart is called the Tech Sector Credit Risk Pricing Chart. It comes from top-down charts and use data from LSEG, which stands for the London Stock Exchange Group. These are serious institutional level data sources. This is not some random internet chart. This is the kind of data professional money managers look at. Now, the chart covers the years from 2004 all the way to 2026. That's over 20 years. Right? That's over 20 years of data. And that's important. It's very important because it happens in the financial world, and this chart captured most of all of them, right? There are two lines on this chart. Very simple. Let me walk through both of them so how to read each one. The black line that's on the left side of the chart represent the US TMT stocks. As you may or may not know, TMT stands for Technology, Media, and Telecommunications. Think of it as basically a price index of big tech and related companies. As the black line goes up, tech stocks are going up. And related companies, as the black goes up, the tech stocks are going up. Simple enough, right? So, and if you could see that black line as being one of the most incredible runs in the stock market history, starting around 2009 and basically going up and to the right for 15 years. Now, the red line. The red line on the right side of the chart, it uses a different scale. The red line represents the tech sector, 5-year CDS. CDS stands for Credit Default Swap. And basically, what we're saying is the credit default swaps, which I used to work quite a lot with it, basically an insurance. You're insuring a credit, you're insuring a bond, you're insuring the ultimate credit of a company, of a loan, right? So in case there is a default, then you're covered. So that's a mouthful. So let me explain what it actually means in plain language. A credit default swap is basically an insurance policy. Imagine you lend your neighbor $100, but you're a little nervous, right? And what if they can't pay you back? So you go to someone else and say, hey, I'll pay you a small fee every month. And if my neighbor doesn't pay me back, you cover the loss. That's an arrangement. That's an insurance. And essentially, this is what a CDS is. In the financial world, big banks, hedge funds, and institutions, they do this constantly. They buy and sell protection on corporate debt. So when you see the tech sector 5-year CDS going up on this chart, that means that the market is pricing in more risk. It means the smart money is paying more for protection against tech companies defaulting or running into serious financial problem. So when the red line goes down, it means confidence is high. It means it's cheaper for you to buy protection, to buy insurance. The market feels safe. People aren't paying much for that insurance. So think of the red line as the fear gauge for the tech sector. Higher the red lines, the more fear. And the lower the red line, more confidence. Okay? Got it? So let's look at what the chart is actually showing us. But before we go into it, don't forget to subscribe and give us a like. And if you want to go deeper, don't think about becoming a channel member. I come to my members every day live and I go into details into what I'm doing, some of my positions. And, you learn a thing or two. So let's start at the very left side of the chart. The year is 2004. At this point, the black line, tech stocks, sitting around 700 to 800. It is relatively flat. Tech is still recovering from the dot-com crash of 2001 and 2002. The sector is healing, right? The red line, the CDS, is already elevated in the early 2000s because memories of the dot-com burst are fresh. But by 2004, 2005, 2006, the red line is actually coming down. And credit markets were coming down. Confidence was building. Meanwhile, something very important was happening in the broader economy. Housing prices, some of you might remember, were skyrocketing. Banks were giving out mortgages to basically anyone. Leverage was everywhere. And the financial system was quietly becoming more fragile by the day. But look at this chart. In 2006 and early 2007, you were feeling pretty good. Tech stocks were holding steady. Credit risk was manageable. And the economy seemed fine on the surface. Then come 2008. So look at the chart right around 2008 going in 2009. The red line doesn't just go up, it explodes. It goes from somewhere around 100 or 150 all the way to 800 basis points. That is a massive, almost vertical spike in credit risk pricing. So basically, we're saying at that time, you were paying 100 basis points, which is $1, 1%, to hedge your position. Now, that same position was costing you 8%. What does that mean? It means the market was absolutely panicking. Institutions were paying enormous amount of money for protection against tech and corporate defaults. Of course, they all assumed that whoever you were buying protection from was actually going to be able to pay you, which was not the case, but that's a different topic. So the whole system was cracking apart. And the black line, you see the tech stocks, absolutely collapse. You can see it falling sharply right around the same period when the red line goes up. The tech stocks got crushed during the financial crisis just like everything else. Now, here's what's fascinating. The CDS market, the red line, actually started rising before the stock market fully broke. Remember that. Credit markets tend to sniff out trouble before the stock market reacts because they are focused on credit, on risk. The smart money, the people trading CS contracts, were getting nervous and paying up for protection even before the worst headline hits. Unlike retailers, the retail crowd, which tends to buy when everybody else is buying, they were actually saying, something is going on. This is one of the most important lessons in investing. Credit markets are often earlier than stock markets when it comes to sensing danger. And if you want to watch the stock market, you can miss out crucial early warning signs. That is the reason I tell my members to watch the 10-year yield. And we watch it every day to make sure that it's not getting out of hand. And right now it's kind of out of hand because it's above the Fed fund rate, which it should not be. So after that terrifying spike in 2008, 2009, something remarkable happened. The red line, the credit risk, came crashing down. Central banks around the world cut interest rates to basically zero. The Federal Reserve launched massive bond buying programs. Government pumped trillions into the economy. And it worked, at least in terms of stabilizing the financial system. And look at the black line from 2010 onwards. Tech stocks began one of the greatest bull markets in history. Every year, almost without fail, the black line marched higher and higher. Facebook, Amazon, Apple, these companies grew into the largest corporations on earth. The red line, which is the CDS prices, stayed mostly low, calm throughout most of this decade because basically the cost of risk, the riskiness of the credit were okay. I mean, there were small bumps. You can see a little bump around 2011 when Europe had a debt crisis. Another little bump around 2015, 2016, a significant spike in 2020 when COVID hit the world. But every single time, the fear subsided. The red line came back down and tech stocks resumed their climb. This created belief in the market, a very deeply held belief that tech stocks only go up. And any dip is a buying opportunity, that the Federal Reserve will always step in to save the market. And for 15 years, that belief was rewarded. Talk about 2020 for a moment. Because it's important to understand where we are now. In early 2020, COVID hits. You can see on the chart, the red line spikes sharply again. Credit risk shoots up. People are terrified. Global economies are shutting down. The stock market drops about 30% in a matter of weeks. But then something unprecedented happens. The Federal Reserve cut rates to zero within days. The U.S. government sends out the stimulus checks. Congress passes trillions in relief packages. And the stock market doesn't just recover. It rockets to all-time high within months in a very worst situation you could think. The red line, CDS risk, comes right back down. Market confidence is restored almost immediately. The Fed is backstopping everything. And from 2020 to 2024, the black line, tech stocks nearly doubles and more depending on which part of the tech stock you are measuring. This is the world most investors have come to know. This is the world they expect to continue. Okay. Here we are. Look at the far right of the chart. You are now in 2025, going into 2026. The black line, tech stocks, is near the top of the chart. It's an all-time high. We are talking about valuation that by historical standards are incredibly stretched. The AI boom has added trillions of dollars in market values to companies like NVIDIA, Microsoft, Meta. Everyone is excited. Everyone thinks the next big thing is artificial intelligence. But now look at the red line, all the way to the right of the chart. The credit risk gauge. It is rising quietly, steadily, and then recently it ticked up noticeably. Now, to be fair, it's not at 2008 levels, right? A huge spike that you see, but it's nowhere close to the terrifying spike that we saw. But there is a thing. That is not the right comparison to make. The right question is, why is it rising now when tech stocks are at all-time high? In a healthy market, when stocks are this elevated, you typically expect credit risk to be low and stable. Investors would be confident. Companies with strong balance sheets, the CDS would be quiet. Everybody's making money. But instead, there's growing anxiety in the credit market. Something is making the institution who trade these instruments nervous enough to pay more for protection. So they're all buying protection. And what happens when you buy protection, right? It's at, let's say it's at 200 basis points. You say, I'm going to pay 200 basis points for this. Then somebody says, yes, I'll pay 210. I'll pay 220. And then you're selling the protection. Now, obviously, remember, for you to buy protection, you're buying protection from another institution. So the other institution is taking on the credit risk. And the price goes up and up and up. It's a measure of something happening. So let's walk through the main reason analysts believe this is happening. First, interest rates. For most of 2010, interest rates were near zero. That meant borrowing was cheap and easy. Tech companies could borrow money at almost no cost to fund their growth. But since 2022, as you remember, the Fed has been raising rates. Why? Well, because they want to fight inflation. And for companies that depend on cheap capital, that is a real challenge. Second, valuations are stretched beyond belief. When you look at the traditional measures or whether the stock is cheap or expensive, a lot of big names are trading at levels that assume years and years of perfect growth. Any stumble, any disappointment, as we saw last week, and these stocks could fall hard. The credit markets understand this, but most expensive stocks mean more downside risk. Third, concentration risk. This is huge. This is huge because the S&P, which is mostly an index that funds track, is now more concentrated in a handful of tech names than almost any point in its history. Apple, Amazon, Nvidia. So they're actually very heavily exposed to tech. So we do not have a diversified portfolio. Right? What do we have? We have really what we have is a concentration portfolio, a concentrated portfolio. And that's a problem. What are we going to do? What's going to happen next? So concentration is an issue. Now, let me explain in real simple terms, because it's one of the most important concepts of the video. Most people who invest in 401k or just standard brokerage account have been told by the index fund, diversify, and you'll be fine. And for a long time, this was excellent advice. But here's the problem nobody's talking about. When you buy an S&P 500 today, you're not equally spread around 500 companies. The index is market cap weighted. It means the bigger the company, the more of the money goes into it. So right now, the top 10 companies in the S&P, most of them tech companies, make up somewhere between 30 and 35% of the entire index. So if you have $100,000 in the S&P 500, roughly $30,000 is a handful of mega cap tech stock. So that's the trap, and that's what the chart is warning you about. What does history say? Well, let me go back to the chart one more time and point out a pattern. Every single time the red line, which is a CDS, has spiked significantly, it has coincided with or immediately preceded a significant drop in tech stocks every time. In 2008, 2012, 2015, 2016, 2020, COVID spike, massive short-term growth, 2022, when we have rates rises and the CDS moves up. And now in 2025, 2026, the CDS is rising again. So what should you actually do? Well, it looks a bit scary, I know, but first of all, you shouldn't panic. This is not sell everything video, right? Timing the market is nearly impossible, and people who try do it usually ends up worse off when they stay the course. But there are smart, practical things you could think about. First, check your actual concentration. Go look at what your index funds actually hold. You might be surprised how much of it is in few tech names. Two, consider some genuine diversification, not just different index fund, but actually different sector. Commodities, value stock, international markets. I do talk about these things when I speak to my members every day to prepare them. Because the time to do it is not when everything is coming down, it's on the way there. Three, have a plan. One of the biggest mistakes investors make is not thinking in advance about what they'll do if the market drops 20, 30%. Now, how often does the market drop 20, 30%? Not very often. In fact, the last time it dropped 30%, 20% on one day was in 1987. But we have seen a couple of drawdowns. 15%, 10%, 80% over 3 years for the Nasdaq. So things happen more often than you think. A couple of percents here and there. And don't forget, if you lose 1%, for you to go back where you were, you need to make 2%. If you have a plan, you're far less likely to panic and sell at the worst possible moment. And four, stay informed. Charts like these exist for one reason. The credit market is in the canary of the coal mine of the financial system. Watch it, understand it. This is what my members and subscribers get from a channel like the Black Swan is you understand what's happening. So you don't listen to the news or react to the news or react to the narrative, which is pretty strong right now. Especially if you think you're getting into Bitcoin, they're saying Bitcoin is going to go to zero. Really? You sure about that? Because if you're not, you're going to lose out on a big run up. So let me zoom out for the big picture so you get a bigger idea, right? So we're living through an extraordinary moment in financial history right now. The last 15 years have been defined by cheap money, technological revolution, and rising asset prices. Index fund investors have been richly rewarded, but no trend lasts forever. Every era in financial markets eventually gives way to a new one. The era of the dot-com dominance ended in 2001. The era of financial engineering ended in 2008. And at some point, we don't know when, but the era of mega cap tech dominance will also face a serious test. The chart we looked at today is not screaming the end is near, but it is gently, persistently reminding you that risk doesn't just disappear because things have been good. In fact, sometimes the longer things have been good, the bigger the risk has quietly built up. So let me give you some final thoughts here. The smart investors I've ever studied, the one who survived the crash of 87, 2000, 2008, they all had something in common. They weren't necessarily smarter than everyone else. They weren't necessarily better at predicting prices, but they were aware. They kept their eyes open. They looked at the signals others were ignoring. They asked uncomfortable questions when things seem too good to be true. That's all I'm asking you to do. Not to panic, not to sell everything, just to look at the signal of the credit. And of course, if you could subscribe, that also would be a good thing. And make sure you understand what you actually own, because the chart doesn't lie. The credit market has been a more honest narrator of financial reality than almost any other measure out there. And right now, it is quietly asking a question that every tech-savvy investor should be asking themselves. Are you more exposed than you realized? Be careful out there. Hello, Mayor. P doesn't match stock price for most of them. Well, the P ratio is quite high right now. That's a problem. You are correct about that, sir. Talk about the P ratio since someone brought it up. show you something very interesting. This tells you very interesting. Let's take a look at this little guy right. So it's an interesting question pertaining to the tariffs. It was not a black swan event. It wasn't a black swan event because the tariffs, everyone, if you looked at it and you kind of look at what they said about the Supreme, not the Supreme Court, but these guys over at the Court of Appeal, they basically had said then that this was not legal. The President of the United States does not have that kind of power. It's a fact. It's not a king. I mean, people joking around about this is a king, back and forth. He's not. Doesn't matter if you like him or not. What you need, you're supposed to go to Congress and ask for these type of things. In this particular instance, they did not ask for it. So it wasn't a black swan event if you kind of understood what was going on. But question is, what do you do now? Because one aspect, thinking about videos of like 2-3 months ago, is okay, so it's illegal. What do you do now? Well, you got to give the money back. Now the money, believe it or not, the money sits with now has been moved to the Treasury. And what do they do with that money? Well, they take it and they offset the money that it's owed to the U.S. government, with the debt, the $37 trillion. So that was a good thing. But if you have to give it back, that's going to impact the bond markets. The U.S. is not going to give it back. They cannot give the money back. It's impossible. So what you're hearing is this. Well, then I'm going to tax. I'm going to put another tax. The tariff situation will be litigated in courts for years, I believe, and that's what. Yes, it's totally right because the Supreme Court said it's illegal, and I say, okay, it's illegal. All right, don't do it. But I did it. I don't know. I mean, so what do I do next? Do I have to give the money back? Do I go to jail? What? No, you shouldn't have done it. What do you do with that kind of information? Right? What do you do with that information? So it is a black swan event in the sense that we don't know exactly how they're going to react and how the other countries are going to react. Are they going to want to piss off the United States? I'm not so sure, but at the end of the day, they could use this to negotiate. So there's a black swan event in there somewhere because we don't know exactly how it's going to react. What if I know nothing about the stock market? How do I learn and how to excel inside that field? If you don't know anything, you should take a look at some of the books that I have. That you should be able to have access to it on the shopping. Read books, not how to make money, because you don't learn how to make money in the stock market by trying to predict the stock market. You make money by understanding risk, and that's a little bit more complicated. So read books, follow my channel. If you want, you could become a member. There, I actually show you what's going on and what it means. It's almost like a class, which is something that I do also. After being an investor, I spend time with my students who end up working at hedge funds. So let me share the wealth. What is the theoretical amount of treasury to be sold to unwind the tariffs? To unwind the tariffs. Not sure what that means. Theoretical amount of treasury. I mean, I think they're gonna about 200, almost $300 billion is coming in from the tariffs. That's a nice amount. But the mayor's right. This is going to be litigated for months to come month. They're not going to stop for a while. And frankly, that's the idea, right? Just negotiate. So, in fact, it was a non-event. Now, of course, you got to applaud the way this is handled, right? That's how you do deals. You say there is no problem. You have a problem. I don't have a problem. Which is great. The only thing is, who's going to believe the United States going forward? I mean, you're basically doing what you want to do. I mean, it worked. You collected $300 billion. And I don't think the other countries are going to go against the U.S. and say, well, give me my money back. I'm going to sue you. Or at least the companies that gave the money, like Ford and GM, do they really want that kind of headache? Because in any way, new tariffs are being put on to replace the existing ones. So what the black swan is in this situation is you don't know how all these pieces are going to fit together. Because technically the fear was if you were to give the money back, in fact, the president himself said it, if you'd say, no, this is going to collapse the U.S. Now he's saying, well, we got contingency plan. It's not going to collapse the U.S. because we're not giving the money back anyway. We're going to litigate, and nothing changes. Let's move on to a different topic. The American consumer and importer paid the tariffs. No, that's correct. Not someone foreign. That's true. Now, obviously, the foreign people are worried about it because if you have 50% tariffs, then you're not going to sell their products. Then you're not paying tariffs and you're buying their products. So they're getting impacted as well. Does an economic degree help in the stock market, or is it just a cheap experience? Yes. I mean, I tell that to my students all the time. They are under the impression that if I can get a job with a master's, then I could go for a PhD. And if I have a PhD or a CFA or an FRM or whatever, especially now, we'll tell you, because of AI, you could do almost, you don't need to code, you don't need to learn programming anymore. You could tell Claude or you could talk to ChatGPT. You could say, build me a Python scripts, do things for me, and it do it very easily for you. So you need to practice. And that's exactly what I do in the morning, not to be too obvious about it, but every morning I meet with my members and I say, okay, what's happening to the stock market today? Right? It's down. Okay, why is it down? What are the things that are happening that are causing it to be nervous? Now, there's two trains of thoughts out there, right? That you believe that the market is driven by narratives, by news, by feelings, yeah, possibly. But I also believe that the market is moved by invisible forces, mathematical forces that nobody really sees or understands except a few people. And those few people make millions like this guy. I think I posted the book for you. But the man that saved the market, that solved the market, Jim Simmons, he made $40 billion and he was a mathematician. So it's a little bit more complicated than that. So what you want to do is you want to learn. I'm in the industry and I could tell you that the tariff situation, oh yeah, no, definitely. For them, and this is kind of where the black swan thing is, because you have no idea. I mean, the car makers have GM, for example, have been paying a lot of money because they afford to import the aluminum, right? So now, why didn't they pass everything to the consumer? Well, because they got to be careful. Because if tomorrow you increase the price of your Ford by 10, 15%, you're not going to buy the thing. You figure, well, this thing is going to go away anyway. And they're kind of right. It kind of went away, although now somehow they have to live with it. So it is chaos. That's uncertainty. And that's the last thing you need. And the market is up and you're rocking a boat that is kind of fragile at the top or at the bottom. Thing like that. You have to be very careful. Because that could be a problem. Let's take a look at the PE ratio. Because that's something that most everyone is comfortable with, and the reason you're comfortable with is because they always tell you about it. PE ratio. I'm not a big believer in the PE ratio because what it measures is. But having said that, it shows you something quite important. And I'll try to explain that to you. Make this a little bit. So this is a PE ratio. This is how you learn. I mean, you learn by listening, but you learn by doing as well. And Like I tell to my members, I mean, look at what I'm doing and selling, but don't do exactly the same thing that I'm doing, because I have leveled, I have a risk of tolerance that is different, understanding, everything else, but see how it behaves. For example, oh, look, silver, right? Look what silver is doing. Okay, it's up 3%. Usually gold is up 1%. Okay, so what do I care? Well, what do you think is moving silver? More people buying than selling. Yeah, but why? Right? In May, thank you very much, Singapore and Philippines. And I do talk about that to my members, that don't forget, international is the way to go as well. So silver is going up and down, and what is this ETF is doing? What is this leverage ETF doing? ETF. There's a leverage ETF that do this, where the market does, the silver does that, so you could make more money or lose more money as well. This option, usually when this option that I'm looking at, whenever the market is up, 0.5%, the options tend to be up 10 to 20 times more. Right? Now, of course, you got to watch it. You can't just let it happen. So that's what you learn on a daily basis, and you specialize in something. But you cannot read a book, even this book, right? Even if I read the book, doesn't mean that I understand everything. I just have an idea and understanding, but he doesn't give you the secret of how to make money. Because if he told you what the secret was, everybody would be making money. There wouldn't be a secret. Very important chart. Long-term investors need to understand. So this chart answers a simple question. Do valuations matter? More specifically, if the market's PE ratio is high today, what does this mean for your returns tomorrow? And not just next year, but over the next 5 years, because that's where the real story is. And what this chart shows may surprise you. So the title of the chart says PE ratios and equity returns. We have two scatter plots side by side. On the left, you see forward PE ratio versus 1 year versus next 1 year return. Right. Forward PE and subsequent 1 year returns on the left. On the right, you have forward PE ratios versus next 5 years annual return. On the right, still the forward PE ratio, but subsequent 5 years annualized returns. So the left is a 1 year return, on the right is the 5 year. Okay, so far so good. Both are based on the S&P 500 Total Return Index. Let's slow down and explain what to read this thing. Look at the bottom horizontal axis. This is the forward PE ratio. Right? Price divided by expected earnings over the next 12 months. This is something that everybody uses, and the reason everybody uses because whenever you go anywhere, Yahoo Finance, Google Finance, anything, they all talk about the PE ratio because that's what everybody kind of see. So if the PE is 10 times, that means investors are willing to pay $10 for every $1 of earnings. The PE ratio of Tesla is like 150. If the PE is 20, then you're willing to spend $20 for every $1 of earning. Now, why are you willing to spend 20 as opposed to spend 10? That's a big question, but that's a different topic. Now, look at the vertical axis. Right? This shows the subsequent 1 year return. So on the left is the return of the stock. So every single dot basically represents the forward PE ratio at a certain time and what the return was expected over the next 12 months, how much money you made. Each dot is an historical observation. Now look at the orange trend line. it slopes slightly downward. This tells us something important, right? On the left, they're both sloping downward. So this tells us something important. As valuations go up, next year's return tend to go down. Okay, what does that mean? Well, in simple terms, it means that the higher the PE ratio, the lower your risk of making money. Look at the bottom right corner. R squared is equal to 4%. That means that forward PE only explained 4% of next year's return, which is a correlation. Look at the box on the left is 4%, and the box on the right is 36%. Now the box on the left is a 1% return. So this means a forward PE ratio only explained 4% of next year's return. Valuation tells you almost nothing about what will happen in the next 12 months. Listen to this. Valuation, or the PE ratio that you keep hearing, that they keep telling you all day long, which I tell my students all the time, yeah, but it's based on the net income, and it doesn't mean anything really. Valuations tells you almost nothing about what will happen in the next 12 months. Markets can still stay expensive. They can stay cheap. Sentiment can dominate. Short term is noisy. Now, before we go any deeper, if you value this type of long-term data-driven breakdown, take 2 seconds and hit the subscribe button or the thumbs up. And I've tagged some books for you, just in case. So, now shift your eyes to the right. Forward PE and next 5 years annualized return. Same idea. The horizontal axis is equal to valuation. The vertical axis is 5-year annual return after the valuation reading. But now look at the orange line. The downward slope is much clearer. What does that mean? Well, and look at the R square, it's 36%. That is not small. That means that forward PE explained 36% of future 5-year returns. That is meaningful. In simple terms, valuation does not predict next year, but valuation strongly influences the next 5 years. That is a key takeaway. So both charts highlight September 30th, 2022 at 15 times forward PE. It's roughly middle range historically. It's not extremely cheap. It's not extremely expensive. Historically, when the forward PE has been around 15, 1-year returns were all over the place and 5-year returns were generally solid and positive. That is what disciplined investing is about. You don't trade on emotion. You position based on valuation and time horizon. Now, why is it that the short term is random? Let's discuss why this 1-year returns are unpredictable. Well, markets move based on interest rates, geopolitics, earnings, surprises, liquidity, sentiment, fear, a bunch of things. In 12 months, anything can happen. Pandemic, bank failure, war, whatever. That's why the R square is very small, because lots of things could happen. And it's very short term. Why does a 5-year return are different? Well, because fundamentals matters. If you overpay dramatically, your long-term return compresses. If you buy when valuations are reasonable, your future returns improve. It's math. So when you buy at 25 times earnings, future return must come from earnings growth, multiples staying high, expanding further. But if multiple contracts, well, returns shrink. That's why 36% R square matters. If the market is trading at a very high valuation, you should not expect strong 5-year returns. Not because of doom, but because starting price matters. So that's why you need to buy very cheap valuation. But doesn't mean you should be buying a low growth stocks. You're expecting long-term returns improve. This is probability. Somebody asked me, how do I know to invest in the stock market? Well, first of all, know that when you look at the PE ratio, if the PE ratio is very low, you should buy. But be careful, because PE ratio tends to be low for low growth company. You need to find a growth company with a low P ratio, right? You need to find Netflix. You need to find Google, Amazon, all these companies before they got out of control with the valuation. And you have to do your homework. Most investors buy aggressively when P is right. Why? Because prices are rising, confidence is high, media is optimistic. That's the other thing you should learn as an investor. Do not buy when everybody else is buying. You need to sell when everybody else is buying, and you need to buy when everybody else is selling. So what is a long-term investor's framework? Instead of asking what will happen next year, you should ask what are likely returns over 5 years given this valuation. This is how pension funds think. That's how endowment thinks. Valuation is a long-term compass, not a short-term timing tool. Now let's connect this to risk. When valuation looks reasonable, black swans can happen. Unexpected events that are not priced in. Financial crisis, policy error, debt spirals, liquidity freezes. These events distort short-term returns massively, but over time, valuation reasserts itself. That is why studying tail risk matters. Again, the book linked below goes deep into these concepts because risk is not volatility. Risk is permanent loss of capital. So let's summarize for you. 1. Forward P. P ratio has almost no predictive power over the next 1 year. P has meaningful predictive power over 5 years. Buying a high valuation reduces long-term return potentials. Buying a reasonable valuation improves long-term probability. Long-term returns are math. Look at the charts, right? You could see that on the right, the chart to the right, the dots are really around the circle, right? They're around the line. So that means that there is a relationship between the two. But still, what does it tell you? As I move to the right, from 8 times, 11 times, 14 times, 20 times, my return is dropping. So the more I pay for a P ratio, the less I should expect. That is what you need to do. Can you quantify black swans like an insurance company? Well, but that's exactly what it is. We're kind of like an insurance company looking for problems, looking for risk everywhere. That's how Spitznagel made 4,000%. Why did he make that much money? Well, because he simply looked for problems and he said, you know what, this COVID thing is going to be a problem. I need to hedge against it. And he made money. Except we're not trying to insure a house. We're trying to make money by looking for unforeseen event. And right now, they are all over the place. Okay. I will be back this afternoon.